Hello and welcome. In today's reality, there is one thing we all agree on: that these are trying times with so much uncertainties due to the current conflict in Ukraine, inflation, rising interest rate, possible recession, pain at the pump, and the current bear market. As dividend growth investors, it is only normal for us to question our strategies due to the effect of these storms on our portfolio. In this video, here are 7 dividend stocks that would help you weather these storms and provide you cash and protection for 2022. Please note the PE ratio on these stocks, as some of these stocks may still be expensive. Disclaimer: this are all my opinions and not to be considered financial advice. Number 7. ABBV. Ticker symbol ABBV. Market cap of $258.03 billion. Current yield of 3.83%, payout ratio of 41.98%, PE ratio of 10.50. So why should you have ABBV in your portfolio at these times? This amazing brand needs no introduction. They have strong fundamentals. They are worldwide. They are sitting on a boatload of cash. Most popular brands include Humira and Botox. They have strong drugs in the pipeline. 5-year stock growth of 31%. 10-year stock growth of 116%. Its 1 and 5-year total return, which include price return and dividend, beats the S&P 500 hands down. Want dividend growth and stocks growth at these times of market and economic uncertainties? Then there's no place else to look except in ABBV. ABBV is just such a valuable company that every dividend growth investor should have. Number 6. Apple, ticker symbol APPL. Market cap of $2.41 trillion. Current yield of 0.63%. Payout ratio of 15.43%. PE ratio of 23.66. So why should you have Apple in your portfolio at these times? This amazing brand needs no introduction. They have strong fundamentals. They are worldwide. Most households in the world have at least one Apple product. They are sitting on a boatload of cash. And they are the king of innovations. Most popular brands include Apple Watch, Apple Computers, iPhones, iPads, AirPods, and their successful offering on Apple TV. 5-year stock growth of 276%, 10-year stock growth of 601%. Apple's 1 and 5-year total return, which include price return and dividend, beats the S&P 500 hands down. With their new focus in EV, this company's best days are still ahead, and I'm going to be part of it. Want dividend growth and stocks growth at these times? Then there's no place else to look except in Apple. Apple is just such a valuable company, and most dividend growth investors agree. Number 5. Lockheed Martin. Ticker symbol LMT. It's also most dividend investors' favorite defense stock. I have a few of this stock. Formed by the merger of Lockheed Corporation with Martin Marietta in March 1995. At the time of this video, Lockheed has a share price of $442.69 and a market cap of $117.09 billion. Annual percentage yield of 2.53%. Lockheed has a payout ratio of 39.81%. Good room to raise the dividend. So why should you have Lockheed Martin in your portfolio at these times? Strongest footprint with U.S. government defense. They have strong fundamentals. They are sitting on a boatload of cash. Biggest supplier of U.S. military. This is the world's largest pure-play defense contractor. They are an American aerospace, arms, warplanes, defense contractor. 5-year stock growth of 59.89%. 10-year stock growth of 431.5%. Its 1-year total return, which include price return and dividend, beats the S&P 500 hands down. Before we move along, we want to implore you to please consider liking this video. We want to get the likes on this one to 750 today, and you can help us because all likes counts, especially yours. Please don't leave us without liking and subscribing. All it is just 2 clicks and you are done. Did you notice our new intro meter? That is to further show you that your time is the most important thing on this channel, and we will never take your time for granted. Please give a like. Thank you for encouraging us with your like and subscribe. Now let's move on. Number 4. The Southern Company, ticker symbol SO. Current price of $75.26. Market cap of $80.27 billion. Current yield of 3.61%. Payout ratio of 77.65%. PE ratio of 21.19. So why should you have Southern in your portfolio at these times? One of the largest electric utility company in USA. They have strong fundamentals. Strong barrier for entry into utilities industry. They supply an essential no one can do without. Reliable growing dividends. 5-year stock growth of 48.18%, 10-year stock growth of 58.84%. Southern's 1 and 5-year total return, which include price return and dividend, beats the S&P 500. Want reliable dividend growth and some stocks growth at these times? Then consider Southern. Southern is just such a valuable company and most dividend growth investors agree. Number 3. Procter & Gamble. Ticker symbol PG. Current price of $145.89. Market cap of $349.43 billion. Current yield 2.5%. Payout ratio of 60.72%. So why should you have Procter & Gamble in your portfolio at these times? This one needs no introduction. There is always at least one product in every household from Procter & Gamble. They have strong fundamentals. They have about 65 individual brands across 10 product categories. PG have grown their dividend for 65 years. Dividend King. Most popular brands includes Mr. Clean, Charmin, Dawn, Cascade, Tide Laundry Detergent, Bounty, Gain, Oral-B, Pampers, Gillette, Always, Crest and many more. There are just too many of their products in consumers' households. 5-year stock growth of 64.29%, 10-year stock growth of 132.49%. Procter & Gamble's 1 and 5-year total return, which include price return and dividend, beats the S&P 500. Number 2. Microsoft Corporation. Ticker symbol MSFT. Current price of $270.02. Market cap of $2.04 trillion. Current dividend yield of 0.92%. Payout ratio of 26.48%. PE ratio of 28.73. So why should Microsoft be in your dividend portfolio at these times? This one truly needs no introduction because their product and footprint is in almost every household and businesses. There's hardly a computer or business that doesn't use one of their software products. They have a strong fundamental and strong moat. They are constantly innovating. Their cloud business is growing. Their business is growing across business application, security, gaming, application and infrastructure, data and AI, developer tools, and Power Platform. Most popular brands include Microsoft Windows, Microsoft Office Suite, Microsoft Azure, Microsoft Teams, Xbox Gaming, LinkedIn, Microsoft Surface. The subscription model for all this product is generating boatload of cash. There are just too many of their products that consumers have no choice but to use on their computers. They're constantly buying back shares. Microsoft's has a 5-year stock price growth and appreciation of 272.34% and 10-year stock price growth and appreciation of 810.69%. Microsoft's 5-year total return, which include price return and dividend, beats the S&P 500 hands down. Number 1. Johnson & Johnson. Ticker symbol JNJ. I'm sure you are not surprised on this one being the number 1 dividend stock to have at times of uncertainties like this. Current price of $176.42. J&J has a market of $467.63 billion. Current yield of 2.56%. Payout of 42.91%. Which means the dividend is secure and has room to grow. So why should J&J be in your dividend portfolio at these times? They have strong fundamentals. They are a dividend king. 59 years long streak of growing their dividend. Most popular brands includes Tylenol. They also have over 100 other brands across dozens of subsidiaries. J&J is a diversified company with businesses focus in consumer health product, medical devices, pharmaceutical and other sectors. They haven't reduced their dividend since 1982. There is hardly any home without one of the J&J products. This is a stock that is also great to hedge against inflation and recession. 1-year total return, which includes dividend payout, beats S&P 500. Remember, all we do is bring you the lists for entertainment. It is your duty to do your own due diligence and/or consult an expert and invest your hard-earned money wisely. Please don't leave us without smashing the like button and give us a subscribe. Think of it as a tip for my hard work. I will greatly appreciate it. Thanks for watching, and I'll see you in the next one. Disclaimer: please note that I showcase these stocks for educational purposes only and shouldn't be taken as investment advice. I don't personally own all these stocks, just some. Please do your own due diligence and/or consult your expert investment advisor, as more fundamental analysis may be needed before investing. Please also note that the past performance of these stocks does not guarantee or indicate similar future performance.